Okay, good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the week of 10th of April. We've all just come back from a very long weekend. I was at Sentosa enjoying a discounted hotel rate at the Hard Rock Hotel. Not really sure what Sunny did, but he does not look as though he's got a sun tan. Um, so what's happening with you for the long weekend, Sunny?
Nothing much. Can't really get a good plane ticket out of Singapore, so probably stuck here at home. Still watching the market. US market was some of the products are still on trading on the Good Friday holiday. So I think what caught the most of the investors and traders' attention last week was, of course, at the beginning of the week we had the surprise OPEC cut, which drove the crude and the Brent up about 5% higher, and then it stayed there throughout the rest of the week. And then through to the end of that week, we had the non-farm payroll data, which was more or less in line, slightly 2,000 below the consensus of 239,000. So a data that is not pushing the inflation higher, a data that's not worrying investors that we are going to see a recession soon. So I think more or less it's a neutral week, a neutral short week for the whole of last week.
Mm. But obviously, the most important news was that Taylor Swift broke up with her long-term boyfriend. I guess that was not really market moving. But of course, for those of you who have this soft spot for Taylor Swift, she is now open or rather available. So do give her a call. But you know that Taylor Swift changes boyfriends, like the way she changed outfits during her concerts. All right. Well, of course, I didn't know she was with this current boyfriend for 6 years. Wow, that's a long time. All right. So with enough chit chat, let's get on with I guess the more serious stuff for this week. Not to say that what Sunny said was not serious. Okay, what I said obviously was not serious, but anyway, the disclaimer is that SIAS is a registered charity. We are not licensed by MAS, so whatever that we talk about today, especially for specific companies or stocks, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. Right. Before we get on to the content, I just want to let everybody know that the upcoming April RCR session is this Wednesday. The one in May is scheduled for the 17th of May. This is usually happens on a Wednesday evening. So if you are already a SIAS member, you can go and book your place by scanning the QR code right here. Now, if you are not a SIAS member, this is where we will try to sell you something. SIAS membership is $1 a month for $12 per year. It's about the same price as a McDonald's upsize Happy Meal. Same price as a Grab taxi during peak hour from Toa Payoh to Orchard, I suppose. So it's what I'm trying to say is that it's super cheap for the kind of lame jokes that you're gonna get. This is like bargain basement prices. All right. Okay, moving on. Now, the content for today, I want to talk about the recession. So last week, JP Morgan said that it was inevitable that there will be a recession by the end of this year. Now, looking at some research that came out of Bloomberg Economics, they have actually quite a good model that tracks 13 economic indicators. And Bloomberg says that the recession can start as soon as July this year. Yes. So I was looking at some of the data they went through. So there is apparently a 97% chance probability of a recession starting as soon as July. And of course, if you go into November or December 2023, it's a 100% chance that there's a recession. We're talking about the US. But of course, whatever happens in the US will revibrate to Singapore. Now, a couple of reasons why the recession is mainly driven by a couple of indices that, or rather matrices that we've been tracking for a long time already. If you look at the corporate profit margins, you look at the S&P 500, the Russell 2000, and 3000, there is a material deterioration of corporate profit margins for the last few quarters already. So now we are back to, I guess we have a chart later on, so we'll talk about that in a minute. Next is, of course, you have got the stubbornly high wages because of wage inflation, because of high CPI. So it's kind of a catch-22 problem here. The labor market is still robust, still tight, although we have a bit of a softening because the job openings have dropped quite a fair bit. But still, we have quite a tight labor market in the US, and this is raising costs for all the companies in the US. Now, at some point, the profit margin will deteriorate to such an extent where the companies will have no choice but to cut capital expenditure as well as hiring, right? In the last labor report, we do have a fewer number of industries actually adding jobs. And the last fundamental data point is, of course, the yield curve, the various yield curves. I mean, a couple of yield curves here. The spreads have been negative for quite some time already. Now, we are specifically looking at the 3-month versus 18 months yield curve spread, simply because this is Jerome Powell's preferred yield curve spread to look at. That already signals a downturn within the next 12 months. Okay, see. All right, now let's take a look at the chart for the corporate margins. As you can see, the S&P 500 income to sales, this is the yellow line, stands now at 11.51. Quite a dramatic shift in the last few months, actually. And of course, if you look at the corporate profit margins, again, quite a dramatic drop from its high of about 12 now to about 11-ish%, right? So it's coming down quite dramatically. So as you can see, if you just apply a very simple technical analysis, this looks like a double top coming down on the downside. So going forward, you're going to see, again, deteriorating margins as well as income to sales, simply because of the high CPI eating into the profit margins. At some point, the companies will not be able to pass on the higher costs to consumers, and this is going to impact the margins. Now, if you look at the yield curve, and we're going to take 3 over here, as you can see, you have got the near-term spread. You've got the 10-year versus 2-year yield spread, as well as the 10-year versus the 3-month yield spread. All of them are negative. And these are in basis points. So if you look at the 10-year versus 3 months, we're talking about 157 basis points. So that's 1.57% negative. So which means that the 3 months interest rate is higher than 10-year interest rate, which is not normal. Okay, so this normally suggests that the bond traders out there think that a recession is imminent, because whenever a recession is imminent, what you call the traditional toolkit from the Fed is to lower interest rates. And, just a primer on this, when you have got interest rates going down, what happens is that the longer 10-year bonds, for example, the 10-year bonds, will then shoot up in price faster than the shorter 10-year bonds, in this case, the 3-year bonds. So as you can see, the bond traders are now positioning themselves in expectation of a interest rate drop. That's why they are all buying up the 10-year bonds. That's why the 10-year bond prices are high. Therefore, the yields are lower than the 3-year bond prices. Hence, you have got a negative yield spread. So this is the classic positioning of the bond traders who expect a imminent recession, and I guess based on the fundamentals and all the models out there, especially JP Morgan screaming that the recession is inevitable, I guess the bond market has already voted with their feet. All right. Okay. Now, last week, the JOLTS job opening report came out. So job openings dropped by 600 plus K to slightly under 10 mil. The consensus estimate was for a drop of 324K, and this is the first time since May 2021 where the US had got fewer than 10 million job openings. Now, this is kind of a psychological barrier, so a nice round number, 10 million. So less than 10 million looks as though the job openings, or rather the job market over there is softening a little bit. Okay, the vacancy to unemployment ratio is now 1.7 job openings per unemployed worker. This is high, historically still high, because the pre-COVID peak was 1.2, but is now quite a big difference between the all-time high of 2.0 that was reached in December 2022. That was only a couple of months ago, so as you can see, the number of job openings is coming off. Now, the quits rate stands at 2.6%, down from a peak of 3% in April 2022, i.e. what it means is that the number of resignations are coming down, so people are hanging on to the jobs that they have rather than quitting to find something better. Now, the labor market, so that said, the labor market is still pretty strong. The initial jobless claims stands at, 228K actual versus 200K estimate. The continuing jobless claims is 1.8 mil versus 1.7 mil. So if you look at the initial jobless claims as well as continuing jobless claims, it looks as though there are slightly more than consensus estimate that the number of people without jobs and having to stay on the dole is still a little bit higher. So that suggests that the people having a little bit more difficulty in finding the jobs that they want. Now, the most recent non-farm payrolls came in at 236K new jobs created versus a consensus estimate of 230K. So it's about spot on. So 6K could be a statistical thing. And of course, this is the initial read. Next month and the month after, it's going to come out with the final number. So that could be revised, but I'll kind of think of it as about right on. The unemployment rate stands at 3.5% versus a 3.6% consensus estimate. And that's largely driven by the slowly increasing participation rate as well as the lower quits rate. All right, so all in, the labor market is still robust, although some indications suggest that it is softening. Now, let's look at the ISM indices. As usual, ISM indices have got two parts. You've got the services as well as the manufacturing part. The manufacturing part already stands at 46.9, which is below 50, suggesting that there's a contraction happening in the manufacturing sectors, but the services index still stands at above 50 at 51.3. What is noteworthy is, of course, if we look at the white line, which is the ISM services index, it's come down quite a fair bit from 54, which is the recent high. If you look at ISM manufacturing, it's already below the 50 line, and that has been happening since, I guess, January. Right, so all indications suggest that the ISM measures are going to be going down and suggest lower growth ahead. If you look at the ADP private services index, again, it's been on a downtrend for the longest time since its peak in early 2021. All right, so again, suggesting that we're going to have slower growth, GDP growth in the months ahead. Now, last week, what happened was that OPEC Plus initiated a very surprising supply cut of up to 1 million barrels per day. This is on top of the current supply cut initiated by Russia in response to the Western sanctions, so on and so forth. So since last week, as you can see, the oil price, this is the WTI, stands now at $80.88. This was about a few minutes ago. Obviously, the Brent crude oil is always trades at a bit of a premium compared to the WTI, so that we higher. But the spread normally is quite consistent, so we're just looking at WTI right now. All right, so as you can see, the day that the supply cut was initiated or announced, the oil price or WTI jumped by almost 8%. It's now, I guess, trading within that particular range, simply because traders have no idea how that is going to impact the upcoming recession. Is it going to make it worse, or is really OPEC Plus really good at reading the tea leaves? So it could also suggest that the OPEC Plus thinks that there's going to be a pretty bad recession in the next few months, and therefore they want to get ahead of it by cutting supply and therefore supporting the oil price. Don't really know. Bloomberg Research has come out with 3 particular cases. The conservative case, that means the best case, in this case, the best case. WTI hovers around $78 per barrel to the end of this year. Negligible impact on GDP growth. We're talking about the US here, and the US CPI hovers around 4.2%. Now, the medium risk scenario, as outlined by Bloomberg Research, is that the WTI will hover around $93 per barrel to the end of the year. That will negatively impact US GDP growth by 0.1%. And let me just say this, the baseline for the US GDP growth is about 0.5, taking into account the recession, but this is on top of the baseline. Okay, so the GDP growth already priced in a recession, so average GDP growth 0.5%. But this is, if let's say the medium risk scenario happens to be true, then GDP growth will be down by an additional 0.1%, and the CPI will then hold around 4.8. Now, the high-risk scenario is that the WTI hovers around $113 per barrel to the end of the year. GDP growth is then impacted by 0.2% lower, and the CPI would then hover around 5.5%. So let's think about this for a minute. The peak, or rather the next slide, the peak US Fed fund rates, as articulated in previous guidance, as well as reading the tea leaves, is that the terminal Fed fund rate will be about 5.25%. If we go back to this high-risk scenario, US CPI hovers around 5.5. Obviously, Jerome Powell and friends will have to consider an additional interest rate hike, beyond the 5.25% terminal rate. So we can envision a scenario where interest rates goes up to about 5.5%, basically to combat stubborn CPI. Okay. Now, needless to say, the medium and high risk scenarios will result in a much deeper recession in the second half of 2023. So again, the base case scenario is that we're heading into some kind of economic slowdown or economic recession in the second half. Is still intact. Practically everybody, as well as the family dog, is screaming is that there will be a recession in the second half. And that is scarcely 2 months away. Oh my goodness. Right. So with that, I'm going to pass the time to our senior technical analyst, Sunny, who is much younger and much better looking than I am.
Hey, thanks, Ben. I hope you can see my screen here from now. So I think the OPEC prices or OPEC production sort of control will definitely drive the inflation higher if they are going to have introduced further cuts. And then that keeps the US Fed hands tight of whether they want to increase the interest rate further and thereby risking a deeper recession, or even want to help the economy by pulling them out of the recession by starting to cut rates. So that is still a pretty much a unknown going into the second half of this year. So this week, we will be looking at the latest CPI print and the core inflation data also at the early part of this week. And then in the middle of that week on Wednesday, we have the FOMC minutes, which will be published on Wednesday. And towards the later part of Friday, we have the retail sales numbers. And these data points might actually move the indices going forward for this week. So let us now look at how the indices have performed for the short week in last week on Good Friday, long weekend. You can see that overall, for the Dow Jones Index for the past 1 week, it's up 2%, 2.07%. Past 1 month is up only about 0.17%. Year to date is up 1.01%. So Dow Jones Index not really moving anywhere since the beginning of the year, and we are done with the first quarter of this year already. So we are also starting to see on Friday this week that the banks will start announcing their earnings. So we have the start of the earnings season starting on Friday, with the US financial banks announcing their performance. So on the technical side, Dow Jones Index, you can see since the low on 16 March at a level of about 31,400, prices has been on an uptrend and hit a peak of around 33,500 or 33,600, and that is on the upper bound of that Bollinger Band. Now, if I look at the MACD indicator, the MACD line and the signal lines looks to have a gap between them. That means that it's a positive MACD reading, which means that there's positive uptrend momentum in the share price right now. And if the MACD line diverges away from the signal line, the uptrend might still continue. However, the peak or the top side of the resistance level that Dow Jones Index will likely see will be the double top formation during the January and Feb period of this year that you see over here. That is the 34,200 level. That will be the first level of resistance that Dow Jones Index will likely see. So the economic data that will probably this week, especially the CPI data, might nudge the Dow Jones Index higher, but then we can see that the peak is actually kept around the double top formation here, which is a bearish formation around the 34,200 level. On the support side, of course, the recent low that in March will actually be a support for the Dow Jones Index. However, the 20 days moving average will also be a first line of defense for Dow Jones Index if it's likely to come down around the 32,500 level. The RSI reading at 60 is about 10 points above the 50-point neutral mark, thereby signaling to us that there's also still some uptrend momentum in the Dow Jones Index as well. So for this week, I will not be surprised as both MACD and the RSI signals to us that there's still positive uptrend momentum in the Dow Jones Index or index points. So if the data is going to trigger the index higher, I will not be surprised if Dow Jones Index retests the double top or the year-to-date high this year around the 34,281 points level. So that's my reading of the Dow Jones Index. Next, let's move to the S&P 500. S&P 500 for the past 1 week is up 1.44%. Past 1 month is up 1.4%. So the one week and 1 month gains is not much of a difference. However, year to date is up 6.5%. That's definitely higher than where the Dow Jones Index is going. So definitely the mid-tier firms are definitely sort of pushing higher, and retail investors are actually still a bit bullish on the stock market right now. although a recession is coming. So since the low that we see in March 13 for the S&P 500 at a level of 38,024 points, prices have also rallied up and then retest this level about 4,114 points level. Now, this 4,100 level was also previously tested during the February period and was unable to break through. The year-to-date high, let me just put a line over there. Year-to-date high for this year is around the 4,195 or the 4,200 level. You can see the 4,100 level was actually the November or December period high that we see last year, and that sort of formed a mini double top formation, which is definitely a bearish kind of formation. So that means the 4,100 level still proves to be a very strong resistance level as of now, at least for the S&P 500. The MACD indicator, the latest reading on last Thursday close at least was 18.30, a positive reading signaling to us that there is a positive uptrend momentum in the share price right now or in the index point right now. And the MACD line is above the signal line. However, the divergence looks to be converging as of last two trading sessions. So that means that the uptrend momentum might be subsiding. But nonetheless, it still has some uptrend momentum in the index points right now. On the RSI indicator, also have the same kind of reading as the MACD indicator. The reading at 60.77 is above the 50-point neutral mark, but not yet above the 70-point overbought zone. So thereby, it is still telling us that there is still uptrend momentum in the S&P index point right now. So I'll not be surprised if the S&P 500 continue to test the 4,100 level and even touch the 4,200 level, which was the January high or the year-to-date high that we see this year. So I think the index point for the S&P 500 is likely to continue upwards this week. However, it will be kept likely around the 4,200 handle. Next, let's move to the Nasdaq Composite Index, the best performer among the three major US index for this year so far. The past 1 week is up 0.65%. The past 1 month is up 3.57%. Year to date is up an impressive 14.45%. So you have invested in the Nasdaq Composite Index, I think you would have captured all the gains for this year, and double-digit gain of 14.45% is actually a very well return for this first quarter of this year. So we can see that the low of Nasdaq Composite Index actually started at the beginning of this year, carrying on from the low in December. So somewhere in the early part of January this year, around the 10,250 level, that was the low that we see this year. And the year-to-date high, we saw it during at the end of January or early part of February. That was the level of 12,200 or 12,300 level, somewhere around there. And then last Friday or last week, we have early part of that week, we can see that the Nasdaq Composite Index is starting to retest this January year-to-date high again at the 12,269 point level. So where is it likely to go? If we look at the MACD indicator, we still have a positive reading of 31.84. However, the MACD line is starting to converge towards the signal line, which is a very obvious signal. And for the past 3 trading sessions, as you can see, the Nasdaq Composite Index the MACD histogram has been indicating that it has been losing momentum for the last 3 trading sessions. Thereby, it means that the uptrend that we see since the low in 13th of March to the high of 3rd April might be coming to an end. And that means that more of the upside has already been baked in, and then this resistance level at the January high will still stand. And that is also the high that we observed on the mini rally that we see in September 2022. On the RSI side, although we have not hit above the 70-point overbought signal, the RSI indicator seems to be moving down since the beginning of April. As you can see, the highest reading we got on 31st March was 65.77, the current reading at 59.55, although still above the 50-point neutral point mark, since that there is positive momentum. But that positive uptrend momentum is very weak, and thereby we can see that the January high at around the 12,269 point level is likely to hold for now, at least for this week. And then the next level up, you will see that this is the higher point of that upper bound of that Bollinger Band at 12,300, forming another resistance level for the Nasdaq Composite Index. So that's my take on the 3 US index. Let us now move to the HSI, the Hang Seng Index. Let me pull out the Hang Seng Index chart for you. Okay, this is the Hang Seng Index chart. For the past 1 week, it's up 0.57%. So this is the rise of the 0.57% for the whole of last week. And then for the past 1 month, it is still down 1.34%. Year to date is up and respectable 3.89%. So the year-to-date high that we observe for the Hang Seng Index is around this level, and that is around the 22,700 level, which is also the June high that we observed last year as well. So if you combine these two tops together, that is a double top formation, a very bearish kind of a formation. That means that 22,700 would likely be a strong resistance level for the Hang Seng Index. Now, the low that we've seen this year is around this period over here, the 20th of March period. So let me just put a line over there to pull out that level for you. Okay, so that is around the 18,900 level. So that is the low of the Hang Seng Index, definitely the near-term support that we will see for the Hang Seng Index as well. And that also coincides with that lower bound of that Bollinger Band around the 19,000 level. So 18,900 level would be a good support for the Hang Seng Index if you are thinking of going into the Asian market to go long for the longer term. The MACD indicator has crossed above the signal, or the MACD line has crossed above the signal line on 23rd of March, signaling that we are seeing a sort of inflection point over here during the middle of March period, and that uptrend that we see is likely going to continue further, because the MACD line and the signal line is looking to push above the zero baseline, and when that happens, that would also means a continuation of the uptrend that we are seeing right now since the middle of March. The MACD histogram reading, although we have a weaker reading on the last two trading sessions, this also means that the momentum might be subsiding a little, but then if you can see the gap between the MACD line and the signal line, it still means that there's still sort of quite a significant amount of uptrend momentum in the HSI index point as well. So the RSI reading, however, on the other side is slightly on the weaker side, very close to the 50-point neutral mark reading, the latest reading at 53.99. So that means that there's still uptrend momentum as it is above the 50-point neutral mark. However, that uptrend momentum for this week is slightly weaker as of now. So for the Hang Seng Index, I think it will consolidate for this week due to the weak momentum as indicated for the MACD as well as the RSI. But definitely the low of this year, the 20th March low that we see around the 19,000 handle or 18,900 level would be a pretty strong support for the Hang Seng Index for the longer term traders who want to go long on the Hang Seng Index. So lastly, I'll move on to our local market, the STI Index, just hovering around the 3,300 level, I believe, as of now. So today it is up 6 points, so pretty much not having any kind of direction, because last week was a pretty neutral week even on the US side. So not much of a catalyst for the STI Index to move a lot this morning. So the STI Index is up 0.94% in the past 1 week. For the past 1 month, it's up 3.26%. Year to date, it's up 1.83% compared to the US and the Hong Kong Index. It's a little bit boring or a little bit neutral. Thereby, that's also the reason why a lot of traders like to trade on the overseas index as well. The low that we see this year for the STI Index is around the 3,100 level, and that was around the 14 March period. Since this low, we can see that there's sort of a mini rally forming for the STI Index, which is mirroring what the US Index is moving as well. And we have come back to the 3,300, which we have touched on a lot of time on the weekly market review. You can see that over here, the November-December period, a double top formation forming here last year, signaling that 3,300 is a strong resistance level. And we also retest that somewhere in the January period of this year. And of course, we managed to break through this resistance level and reach a peak of 3,400 somewhere at the end of January. But that optimism has been pushed all the way down of the STI Index to the 3,100 point level. So where is STI likely going to move? Definitely 3,300 now is since the resistance has been broken in January. Thereby, it becomes a pivot point. So market is using this. If there's a catalyst to push market higher, 3,300 might become a support or a pivot point level. However, if it's going to move lower, then 3,300 might come back to become a formidable resistance level. The MACD indicator reading now at 13.78 shows that there's a positive uptrend momentum in the STI Index points. However, the last two sessions, I would think that because of the long holiday, some of the traders might take some profit off the table right now, thereby there's a bit of a weakening of that momentum. However, the gap between the MACD line and the signal line is still pretty significant, thereby telling us that there may be a significant uptrend momentum still present in the STI index point right now. The RSI is also pretty strong at 61.01 latest reading this morning. So it is about 10 points higher than the 50-point neutral marks, telling us that there is a positive uptrend momentum definitely in the STI index point, and the index is likely going to trend higher. So I think for now, STI index, according to the indicators, it may likely trend higher and use the 3,300 point level as a support level, and maybe retest the 3,400 level that we see. This is the year-to-date high from in January. And when that happens, we'll likely see the RSI index move up towards the 70-point mark, which is the overbought zone, thereby triggering a reversal from there of the STI index. So with that, I have covered most of the major indices this week. I think that's all that we have for this week weekly market review video. In the meantime, trade safe. I'm signing off here into the closing slides.
Okay, so thank you very much, Sunny. So for all you guys out there, have a great week ahead. Just as a heads up, we do have another public holiday or long weekend next week, which is kind of great, right? So yeah, so as Sunny has mentioned, trade safely, and we will see you next week.